Why investors need emotional fitness. Have you ever sold an investment because the market looked like it was falling apart, only to watch it recover weeks later? Or bought into a stock because everyone online seemed convinced it was the next big thing, only to see it crash soon after? If that sounds familiar, you're not alone. Here's the uncomfortable truth. Most investors don't lose money because they lack knowledge. They lose money because they lack emotional fitness. Think of emotional fitness like physical fitness. You don't build strong muscles overnight, and you don't build emotional discipline after reading one investing book. It's something you train, especially when the pressure is highest. The stock market is one of the few places where emotions are constantly tested. Prices rise, excitement spreads, and suddenly everyone feels like a genius. Then the market drops, fear takes over, and that same crowd starts looking for the exit. The market changes, but human psychology rarely does. This is why market timing is often less about charts and more about emotions. Fear whispers, "Sell before it's too late." Greed shouts, "Buy now or you'll miss out." Both voices feel convincing in the moment, but they rarely lead to wise decisions. Legendary investors understand something that many beginners overlook. Warren Buffett once said to be fearful when others are greedy, and greedy when others are fearful. That sounds simple, until your portfolio drops 30%. In those moments, emotional fitness matters far more than intelligence. Imagine two investors, both buy the same quality company. One checks prices every hour, panics during every market correction, and jumps from one investment to another chasing the latest trend. The other focuses on long-term goals, accepts that volatility is part of investing, and sticks to a well-thought-out plan. Years later, the difference between them isn't luck, it's emotional discipline. Neuroscience helps explain why this happens. When markets become volatile, the brain's threat detection system becomes highly active. Your body reacts as though you're facing physical danger, even though you're simply looking at numbers on a screen. That's why panic selling can feel strangely logical in the moment. So how do you build emotional fitness? Start by creating clear investing rules before emotions take over. Decide your investment strategy in calm moments, not during market crashes. Limit how often you check your portfolio. Constantly watching prices magnifies emotional reactions without improving long-term results. Next, stop comparing your journey to social media success stories. People love posting their winning trades but rarely share their costly mistakes. Comparison fuels impatience, and impatience is often the enemy of wealth. Another powerful habit is keeping an investing journal. Before buying or selling, write down why you're making the decision. Later, review your notes. You'll begin to recognize emotional patterns that quietly influence your choices. Self-awareness is one of the greatest investing advantages you can develop. Remember, the goal isn't to eliminate emotions. That's impossible. The goal is to make sure your emotions don't make your financial decisions for you. The greatest investors aren't those who predict every market move. They're the ones who remain calm when everyone else is emotional. They understand that wealth is built not by reacting to every headline, but by consistently making rational decisions over many years. So here's a question I'd love you to think about. If the market dropped 25% tomorrow, would your next move be guided by your plan or by your emotions? If this conversation gave you a new perspective, subscribe for more insights into the psychology of investing, because mastering your money begins with mastering your mind. Until next time, stay patient, stay disciplined, and remember, your greatest investment is the mindset you bring to every market cycle.